All of a sudden, the EU is talking about bank bailouts. You heard it just a few minutes ago right here on the Inside Track. The European Commission saying that, yes, Europe may turn to its permanent rescue fund, the European Stability Mechanism, to recapitalize those shaky European banks. And we've got the perfect person to talk about it. Peter Fisher, he's global head of fixed income at the world's largest money manager, BlackRock. Peter, we have a lot to talk about. We knew we were going to be talking about Greece. We knew we were going to be talking about Europe. But all of a sudden, we get to talk about bank bailouts in Europe. Have we finally crossed the threshold where Europe gets it, that there is no alternative than to inject capital into the banks? And is it going to work? Are the Germans, are the French, are the Dutch, are the Finns going to support this?
Well, I think there's an increasing recognition. Having the Commission come out with this report is a really positive step, that if you're having a crisis in the euro, it's a crisis of bank money. It's not about little pieces of paper. It's about deposits people have at banks, and you're worried about whether there's deposit flight going to happen.
The risk of a bank
the risk of more deposit flight. That's what they're worried about, and that's concentrating the minds of the policymakers in Europe. Finally, it's taken two and a half years. So I think it's a positive step, but there's a lot more they need to do to recognize they have a common banking system. They've had what they call the passport. Banks can open up and collect deposits in any country in Europe they want to, but the deposit protection scheme is back in their home country. That was all the problem with Iceland, if you'll recall.
Doesn't this speak to the issue that it is not the United States of Europe? And even though there is the EU, even though they do have some commonality, it's not one nation. It's not like the United States where they truly have one motivation. There's a huge cultural divide.
That's certainly true. We still had prohibitions on interstate banking 20 years ago. Right? So it took us a long time to evolve to the point where we recognized it was one banking system.
Then is it too late for Europe to get their act together? I mean, they're finally saying, hey, we're going to step in now, but it's just a statement, maybe even a head fake. How long till they can implement this and really have a rescue? People can pull their money from Spanish banks today.
That's certainly a risk they face. And I think, in a sense, it's a bigger issue than whether Greece stays or leaves the euro. Obviously, that's a big issue for us in the market. But whether they stay or go, we're going to be left with the question of, is it one banking system? Is there one system of common support for the banks?
Well, the question is, who pays for this banking recapitalization with the sovereigns and the banks so intertwined in this crisis? I mean, how can you feel comfortable buying into these European bonds?
It's a problem. Imagine 20 years ago if we tried to solve the Texas S&L crisis by rolling up the Texas S&Ls on the Texas state government. It just doesn't work. You can't do that because then the thing implodes on itself. So I think it's really important they find that it's in their common European interest. Whether you're German or Dutch or Italian, you want a banking system that's stable for Europe.
Sure, and that sounds right now, but when we recapitalized the banks, nobody complained that TARP money was going to a bunch of New York banks. They didn't complain that it was going to
Sun Trust. Oh, yes, they did. Oh,
no, but they didn't say that it's going. You know, we're keeping score, right? There's this much money is going to Sun Trust, this much money is going to J.P. Morgan, this much money is going to Citigroup. Of course, New York is the financial center. But that's what they're going to be doing in Europe, right? They're going to look at exactly how much money is going into the Spanish banks, which we hear need, 50 to 60 billion euros of recapitalization. They're going to be looking at exactly how much money goes into the French banks, say, or the Italian banks. And will it be so easy, once the money has gone in, to determine, who's on the hook? I mean, will the rest of Europe really tolerate the idea that it's permanently on the hook for the money that goes in if they can't successfully recapitalize the way that we did post-TARP?
Well, that's the choice they have to make about whether they really want to have a currency union. As I say, most of the money is bank deposit money. So to create a currency union without a banking union was a much bigger mistake than a fiscal union issue. I just don't think you have to have a fiscal union. But not having a banking union, that's a problem.
This talk of direct aid into the banks is a pretty big breakthrough, as Erik alluded to, but you're not seeing much of a reaction in markets. I mean, they came off their lows a little bit, but are still basically where they were before. Is something like a euro bond the only solution that to turn sentiment around?
I think the euro bond is sort of a hope and a wish. But unless you're going to have a unified taxing system to support the euro bond, it's just a set of words, right? Unless you unify the taxing power with the borrowing power, who's going to pay back the euro bond? You don't want to have to negotiate with the 17 governments every time you have to repay a bond. So it's actually much more important to stabilize the banking system, have a common deposit insurance scheme, a common resolution scheme. Those are the big steps they have to make to calm the crisis down. If they don't get around to it before Greece leaves or making big steps, then a Greece departure is even more disruptive to the weaker banks.
Here's a question for you. If that's not done, are we going to see a Lehman-style bank failure in Europe?
No, we could see bank failures. We could see pressure on banks. But I think the ECB, what they did with the LTRO at the start of the year, tells you they know they want to, in Secretary Geithner's words, put foam down on the runway. So they are not going to want to see that kind of surprise collapse of a major firm, and they will do everything in their toolkit to do that. The problem is the ECB's toolkit isn't as big as the Fed's. The ECB was not set up to be a financial stability agent. The Fed was set up in response to the banking panic of 1907. We had the experience of the Great Depression. So it's in the Fed's DNA to want to respond to a banking crisis. It's not in the ECB's DNA to do that. And so we know they have the tools. I think they'll want to try to do it. So I don't think we'll see a Lehman style, that's what you said, because they'll put the foam on the runway, they'll open up the LTRO.
Doesn't mean it won't be messy, though.
It doesn't mean it won't be messy, and we won't be unhappy about it.
But this creates such an overhang of uncertainty. So for you, I mean, you have major waters to navigate here and really troops to lead at BlackRock. How do you do it? How do you know how to trade this? Technicals are terrible. Liquidity is worse than it's been in months. And you have a massive amount of money to manage and institutional investors who are saying, we want big returns here. So how do you know where to put your money and how to trade it?
Well, in this environment, you're absolutely right. High vol, low liquidity, you have to bring your bets down. You have to be much more conscious about the size of your bets and the diversification of your bets.
But if you sit in cash, aren't your pension clients on the other side saying, show me the money?
Yes, that's a struggle we have with them, and they have themselves, but they also want to preserve capital, right? So it's embedded in the challenge they have. But we do face this challenge, and I think being aware of how much risk you want to take, and the volatility of vol is much higher, and that means you've got to be much more judicious in your risk-taking.
You mentioned the Fed has more tools at its disposal. Does that mean investors should be looking to the Fed this year to ease more, to make things a little bit easier and spur risk in the markets over the ECB?
Well, it depends on what's the cause. I think that's the challenge for the Fed. The Fed's done a lot, and if it's a banking crisis we're worried about, well, the Fed's already put a lot of liquidity in the U.S. banking system. If there was a bigger banking crisis, I'd expect they'd do it again, but that doesn't seem to be in the cards here. That's really a European matter. But if European banking strains spill over into us, yes, the Fed would respond. I really mean it's the absence of the ECB's propensity to be a lender of last resort.
Let's stay with the U.S. because banking crisis is not something we're dealing with here, but the prospect of a fiscal crisis is something that everyone's warning about, the fiscal cliff at the end of the year. How do you see this resolving itself, or not, perhaps?
Well, I think we'll get to the end of the year, and Congress won't want to have a recession next year. Right? And so they'll do some marginal something. It depends on the outcome of the election.
Of somehow.
The real problem is we in the markets don't want to wait till December 31st. And Congress is going to have a rude wake-up in October when the markets start pricing in the uncertainty of a recession in 2013.
Peter, you're the global head of fixed income at BlackRock. Given the choice, what do you like, treasuries or bunds?
Treasuries, by the way, 10-year yielding 1.69% right now.
They're both not a return play. They're both a safe haven liquidity play. So
do you see credit risk in Germany, though? Do you see what we heard from one of our earlier guests, Bob Janjua of Nomura, saying, you know what, I'd be buying credit default swaps on Germany. There's credit risk there. If Germany has to be the firewall for the rest of Europe, that's going to be, at some point, that's going to be priced in, even if bunds are trading in the, whatever, cheaper than treasuries.
I don't think of that as credit risk. It can certainly back up if they have to issue a lot more bunds, if the German economy looks like it's going to pick up speed, which it doesn't look, you know, Europe's coming to a slow down, so that's a little different. But I can see events in which bunds back up, but these aren't those events we're looking at now. What we're looking at is people want to invest in the safe haven assets. So you don't buy treasuries or bunds, either one, as a return play.
What buy corporate bonds.
One answer. What do you buy as a return play right now?
You look at high-quality corporates in fixed income. You have to, because the central banks are hoarding all the duration. So they're sending you the signal. They're gobbling up the duration. They're bringing rates low. You can make money on term premium or you can make money on credit premium. The only one left is credit premium when you really strip it all down.
High-grade corporates.
Yes.
All right, Peter, great to see you, and thank you for coming.
Thank you.
See you again soon. Peter
See you.
Fisher, he's the global head of fixed income at BlackRock.